The Indian stock market has been falling, and it's been falling for over a month now. What's been happening? This is very surprising since this probably is one of the most resilient markets across the globe. It seems like it's a combination of things: the global economic impact, massive withdrawal by the FIIs from the Indian market, the union budget of the Indian government 2025, all combined seems to have had a negative effect and on bringing it down. Let's study this a little more and delve deep in the next few minutes.
3, 2, 1.
Let's go.
The UN predicts the global economic growth of GDP to be around 2.8% this financial year. This is even lower than the pre-pandemic levels for the globe. What's causing this is a series of factors, some we know and some very new ones. The high debt in most countries across the world, where there were reckless printing of money during the pandemic period, low investment on infrastructure, and the increased tensions between the US and China, which impacts trade, is worrying investors. Combine this with a US government led by Trump, which is focusing on tightening monetary regulations and talking about tariff increases with most of its big trading partners. All these are making investment in the US far more attractive than investing in emerging markets like India. So you see this massive move out of FIIs and taking their money out from markets like Indian markets and going back and investing in the US markets. If you look at the foreign institutional investors, the FIIs, and their ownership of the Indian stock market over a period of 10 years from 2015 to 2025, you see a massive decline in the percentage from 20.2% to 16% now. That's a massive outflow. In January 2025 alone, over 2 billion worth of stocks were sold by FIIs, and they went back and invested in the US market. Why? Because with the US bond yields looking better, the Indian rupee weakening, and Trump and his predictions on what he wants to do on the economy, all makes US a far more attractive destination than markets like India. This massive outflow from the Indian market directly impacts our markets and drags the stock market down. On February 1st, Mrs. Nirmala Sitharaman, the finance minister for India, she presented the union budget on behalf of the government. The two broad stories of the budget, one was it was very exciting for the middle class. There were tax cuts, there were a lot of sops for the middle class, which made it great for the consumers. The second was it was a little bit disappointing for the investors because capital expenditure was low. They were expecting investments into infrastructure projects far more aggressively, which would help in long-term growth, which didn't happen, and it resulted with very mixed reactions and seeing both the Nifty and the Sensex being dragged down post the budget. To add to the woes, the corporate earnings came weaker in Q3. IT and banking, which are crucial to the stock market, came with lower than expected Q3 earning results. The small cap took a bigger hit, with the Nifty smaller caps taking a 24% hit over its peak. Inflation concerns come on top of that. RBI's recent repo rate cut didn't help much in calming the concerns of the investors. On the brighter side, the domestic institutional investors, the DIIs, came in and invested in the market, but the exits of the FIIs were so massive that the DI investments could not offset that outflow. Until the FII sentiment improves, the markets will continue to be a little unstable. But have heart, most experts like Goldman Sachs and the others are forecasting an around 27,000 level for the Nifty 50 by December. So stay calm. So what this means for you as an investor, the markets are more likely to be unstable for the short term ahead. But no need to panic. The markets will always be going up and down. In fact, like Warren Buffett says, when it's down is the best time to go and invest. Diversify your portfolio. Identify strong stocks which you know will be stable and invest in that. Stay calm, stay informed, and above all, don't make any emotional decision. To summarize, the Indian market is impacted by a mix of global economic slowdown, the FII's withdrawal, and some of the messages from the Union Budget 2025. But there is no need to panic or to make any emotional decisions. The market is expected to recover by the end of the year. So till the next time, stay unstoppable.